This is almost diabolical that it is not taught in schools, and I'm so thankful I had self-educated and figured this out when I was 23. But if you're making any money and you're in your 20s right now, you have to understand that it's not about the amount that you're making, it's about the amount that you're saving, because it is exponentially worth so much more than it is to somebody at my age who is now 33. But take a listen to this, and I want to expand on it a bit.
If you've got kids or grandkids in their 20s, you might want to show them this. This might be one of my favorite models to build in Excel. It might be the most simple and powerful thing I ever share. Let's imagine two people, Ben and Joe. Ben saves $10,000 a year for 10 years and then stops forever. Joe waits 10 years and then saves $10,000 a year for the next 30 years. And so in total, by age 60, Ben has saved $100,000 and Joe has saved $300,000. So if we assume this money is invested, who do you think ends up with more money at retirement? Well, if we assume a 7% rate of return, Ben's 10 years of savings grows to $1,125,000. And despite only saving a third as much as Joe, Ben finishes with over $100,000 more. And if we increase the assumed rate of return, this difference just gets bigger and bigger and bigger.
Yeah, it is absolutely wild if you get up to a 12% rate of return, how that measly, and it's not measly, but obviously that 100 grand can quickly accumulate into like $3 million for somebody that has to accumulate so much more and work so much harder. Compound interest, Albert Einstein is considered one of the wonders of the world that is probably the most underappreciated wonder. And I'm always sitting here listening to TikTokers like, oh, I want to enjoy my money. I want to enjoy my life. But you don't understand, like if you're buying a new car for say $40,000 or $50,000 at 20 years old and you're financing it, which is insane, it's not a $40,000 or $50,000 car you're buying. Let's just say it's, to make the math easy, a $50K car, right? And let's say you're 20 years old, you're going to retire at 60. It means you've got like a 40-year run rate ahead of you. That 50 grand, if you didn't put it into that vehicle at an 8% rate of return, is $1 million. You just spent $1 million on a vehicle that was sold to you as a lie for 50K and then financed to you at probably like a 6 to 8% interest rate. And you might be saying, oh yeah, but I still need a car. Well, do what I did. Even still at 33, I am driving a $7,000 car. I bought it back in 2020, just before the pandemic. Best car I've ever bought because it's the cheapest I've ever owned. And I know you want to enjoy life. I'm not saying don't enjoy life, but you have to pick and choose and delay gratification on what I consider to be luxury broke brands. Broke people wear luxury brands. A lot of rich people, you wouldn't even know they're rich, but even still, if you had to buy a $10,000 car cash over a $50,000 car, you saved 40 grand over that time. If you could just invest it, over that 40 years, it's still 868,000. And this comes back to the same point of coffee. Like you could give up something very simple and completely change the financial outcome of your life. And people say, well, I might not even live to 60, but a young kid doesn't look past tomorrow. But trust me, life and time fly by like this. And there's nothing worse than being a burden to the people around you, let alone to yourself, when your body starts to ache and you feel pains and your boss is slave driving and you don't have a choice because you're stuck living in a shitty apartment or something like that. Like, live life frugally and a little bit more scrappy while you have the opportunity to do so. And I love the idea of coffee because everyone likes their disgusting overpriced Starbucks. I'm more of an instant guy here, but if you spend $5 a day on a beverage or a drink or something that's a bit luxurious in that sense, over 365 days is $1,825. If you did that every year from the time you were 20 again till the time you were at retirement at 60, I mean, that's $500,000, and that's at an 8% return. Now, if you can get 11 or 12%, I mean, you're talking about 1.5 million. Anywhere from $500,000 to 1.5 is the range you would end up in just saving $5 a day from the time you are 20 until 60. And if you're somebody like me that wants to fast track that financial independence, get to that place of retirement early on, because I'm looking to retire by the time I'm 35. And I understood that over a 10 to 15 year period, if you could put away 50% of your income, regardless of your income bracket, that you could very quickly accumulate your way to retirement, especially on the back of this market that we've experienced. It's been an incredibly powerful bull market, unlike any history before us. So to be a millennial, you've been incredibly privileged if you were able to take control of the investment market, whether it was through real estate or through the stock market itself. But let's again just do the math. If you want to fast track your financial independence, somebody like myself is at minimum looking to put around $2,000 away a month, or about $24,000 a year. I'm also somebody that has had the luxury to analyze stocks, work in the market, and actually get excelled returns through very diligent investing. This is going to be different for everybody, obviously. And let's say I was 23, 10, 15-year period. Let's just say over a 15-year period, if I was able to do that, and we'll just bring it down to a more modest 10% rate of return. I mean, you can very quickly see how that almost fastly accumulates to $1 million. And then if you're able to just make 10% on $1 million, that's 40, or 10% on $1 million is 100,000 a year. And if you just draw 3 or 4% of that away on years when the market's doing exceptionally well, make sure you have an emergency fund for the years the market's not doing well, you could easily draw and substitute part of your life off that 40 grand a year. And I'm not saying that's a very luxurious lifestyle by any metric, but again, if you want to look for those investment vehicles that help drive that, a lot of people point to things like the Vanguard Total World Stock Market Index and the S&P 500 because it has over 100 years of history behind it. Now, obviously, there's a variety of different investment vehicles, whether you want dividend income so you don't have to touch the initial stocks themselves. I'm more of a growth-oriented or a total return-oriented investor, and I don't really care about collecting a 3 or 4% yield when I'm more focused on getting about a 10 to 20% yield return or total investment return over a year. But you can see VT, this is a total market index, so it doesn't even just focus on the US. It takes in the entire world's best performing companies and it weights them by market cap, so you're always exposed to the best companies and at the scale of the best performers. And this, since it came out in 2008, has returned about 7.77%. Over the last decade, 9.26%. And over the last 5 years, a very generous 13.35% if you've been investing 5 years ago in this ETF. And if you scroll down, these are all companies you're going to be well aware of, and they're going to change over time. But again, it's a passively weighted ETF. It's not based off feelings or emotion. It's just the performance and size of the company's market capitalization. So you can see Apple, Nvidia, there's Tesla in here. And if you go down, you're going to probably start seeing some of the global stocks like Taiwan Semiconductors. Costco's in here. I'm sure the further you go down, the more you're going to see some foreign exposed stocks in here. SAP's in here. Nestle's in here. Philip Morris International. A lot of great companies, right? So these are incredibly simple methods of understanding finance that will absolutely change the trajectory of your life. And I know a lot of people watching this might be in their 30s. They might just be getting started and saying, damn, I wish I knew this earlier. And we all wish we could have started when we were 10 years old, but the next best time to plant a tree is today. And I really, really wish I could have instilled this so much more in my friends and they just understood the value of compounding, because I'm a millionaire at 33. My wife and I very much follow the same financial rhetoric of being diligent, investing, and frugal, but I'm also a guy now that likes to enjoy travel. I have a comfortable lifestyle here in Toronto, but all of that was set up and predicated from frugality, living with my parents for longer than most people would have liked. If you could live with friends or a group of people and reduce your rent dramatically, anything that it takes, not buying a new car, buying a cheap car with cash and surviving on that, and really starting to build out an investment portfolio, because I never have to invest another dollar today, and I know I am set up for the rest of my life. But as somebody that is enthralled in this world, I am not stopping anytime soon. And it's crazy that I was able to document it on this channel from 2019 when I hit my first 100K to where we sit today is almost just mind-boggling at how fast this can really take effect. And I hope you guys are taking this in and finding your own route to financial independence and prosperity for you and your family. It is a really beautiful thing, and it is a lot simpler the earlier you start. So I'd love to know what you think, how your journey's going, and anything you think about this in that comment section below.